Welcome to this deep dive, everyone. Today we're jumping into the world of stock picking, specifically looking through the lens of beating the street, which captures some really interesting thinking from the early to mid 90s. You asked about this one, and we're ready to unpack it.
Yeah, there's a lot here. Insights about individual investors, professional managers, how to actually approach the market, all based on observations from that time.
And we've got a ton of material, haven't we? Anecdotes from managing well, the massive Magellan Fund, market trend observations, actual stock analysis examples.
Exactly. Our mission really is to pull out what's still relevant and insightful for you listening, whether you're deep into investing yourself or just, curious about how it all works.
Right. And one core idea that really stands out to me is this concept that amateur stock picking isn't dead, that maybe regular folks still have a shot, even against the pros.
Absolutely. We'll look at some stories that kind of push back against the idea that you need like a PhD in supercomputers to succeed.
Should be interesting. Expect some maybe surprising angles and some practical stuff too.
Definitely.
Okay, so let's dig into that first point. This idea that amateur stock picking was declining. The author noticed this after the big 80s bull market, right? Fewer individuals holding stocks. What did he think was going on?
Well, it seems like a few things were happening at once. For one, Wall Street professionals were becoming almost like celebrities. The media really built them up.
The star fund manager phenomenon.
Precisely. And that created this feeling, maybe, that the average person just couldn't keep up. It could be pretty intimidating.
Yeah, I can see that. But were there also maybe good reasons people were moving towards professional management, like markets getting more complex, maybe needing diversification?
That's fair. Markets are getting more complicated, and diversification is always important, especially for smaller investors. But the author also pointed out that brokerage houses weren't really teaching fundamental company analysis as much anymore.
Oh, interesting. Why not?
Well, if fewer people were picking their own stocks, there wasn't as much demand for that kind of education from the brokers. He kind of compared it to old family recipes getting lost when everyone starts buying prepackaged meals.
Huh. That's a good way to put it. But it wasn't like information just vanished, was it? He mentioned brokerage computers had useful data.
No, definitely not. Actually, computers were making more data available. Things like screens, lists of companies sharing certain traits like, say, consistent dividend growth were becoming tools investors could use.
So the data was there.
Yeah, but maybe the focus of the brokers themselves was shifting a bit.
How so?
They started selling a much wider range of things, not just individual stocks, but annuities, mutual funds, limited partnerships, you name it.
So they had to become generalists almost.
Kind of. They needed to know enough about everything to make a sales pitch, which maybe left less time for deep dives into single companies. Plus, let's be honest, often the bigger commissions were probably in those other products.
Right. So the system, like maybe not on purpose, was kind of nudging people away from picking their own stocks.
It seems that way.
But then you have this amazing story about the St. Agnes School seventh graders. Tell us about that one.
Oh, it's brilliant. It really cuts against that whole you need to be an expert idea. So 1990, a seventh grade class decides to manage a stock portfolio.
Just like that.
Their teacher wanted to see if the theory held up that you don't need, an MBA or even a driver's license to pick good stocks.
Okay, I love this already. How did they do? The book even lists their top picks, doesn't it?
They did great. Seriously, their performance was fantastic. It was a real argument for the idea that just understanding businesses you see every day can be really powerful.
And their picks reflected that. Familiar companies.
Yeah, look at Table 1-1 in the book. Lots of familiar names. It just showed that basic common sense and observing the world around you can actually work pretty well in the market.
That's fantastic. Really encouraging for anyone listening who feels a bit intimidated. It doesn't have to be some sort of secret code.
Exactly. Opportunities can be right in front of you.
Okay, so even seventh graders can find success. Let's pivot now to another really key element, time. The power of time in market and just investing regularly. The book has some good examples here.
It really does. He starts with a simple hypothetical. Put $1,000 in the S&P 500 back in 1940. Over 52 years, it grew significantly, obviously.
Standard compounding example.
Right. But then he shows what happens if you add another $1,000 just regularly every year for those 52 years.
And the difference is huge, I assume.
Dramatic. That consistent contribution just turbocharges the end result. It really hammers home the power of regular saving and investing, even small amounts.
Okay, so consistency pays off. What about buying when the market drops? That takes guts.
It does. But he models that too. adding another $1,000 every time the market fell 10% or more, which happened, what, 31 times in that 52-year period?
Wow, that often.
Yep. And while it's tough mentally to buy when everyone else is panicking, the potential payoff in his example was massive. It beat just the initial investment, and it beat the regular annual addition strategy too.
So the core message seems to be discipline and a long-term view beat trying to perfectly time the market highs and lows.
Absolutely. He even mentions this weekend worrying thing. Apparently, even the experts at the Barron's Roundtable, guys with great track records, would get stressed about short-term dips.
Huh. So even the pros aren't immune.
It just shows how hard, maybe impossible it is to consistently predict those swings. A regular schedule, focusing on the long game, that seems to be the wiser path. And focusing on the companies themselves, not just the market noise.
That makes a lot of sense. Okay, let's talk about funds, mutual funds specifically. Since he was this legendary fund manager, you'd think he'd be all for them, but his view seems a bit more nuanced.
Yeah, apparently after the first edition came out, some people thought he was against mutual funds. He had to clarify that in the paperback.
Really? So what's
Huh.
his actual take?
He actually says they're a great solution. Perfect even for people who want stock exposure, but just don't have the time or maybe the interest to do all the individual company research.
Okay, so they're a valid tool for lots of investors, but he adds a caveat about time horizon.
A big one. He stresses that because markets are unpredictable in the short term, you really shouldn't put money into an equity mutual fund unless you plan to leave it there for several years. You need to be able to ride out the ups and downs.
Patience is key. And he points out that even the experts recommending funds don't always nail the big market calls.
Yeah, that Barron's Roundtable anecdote again. He notes that while their specific stock picks often turned out well over time, their predictions about where the overall market or economy was headed were frequently wrong.
So maybe don't hang on every macro forecast.
It certainly suggests that focusing on your specific investments for the long haul might be more productive than trying to guess the market's next big move based on those forecasts.
Okay, so if that's what he chooses mutual funds, does he suggest any particular strategy? Like just pick one broad market fund?
He actually advocates for diversifying across multiple funds with different styles.
Different styles? Like what?
So you might have one focused on capital appreciation, looking for growth stocks, another focused on value, finding companies that seem cheap based on their assets. The idea is that different styles work better in different market conditions, so spreading your bets helps smooth the ride.
That makes sense. Don't put all your eggs in one style basket. Does he mention other types of funds?
Yep. He talks about sector funds. If you're really optimistic about, say, technology or healthcare, you can buy a fund that just invests in that industry, avoids picking individual winners or losers within the sector.
A more targeted bet.
Exactly. And also country funds, a way to invest in foreign economies. He notes they can offer faster growth sometimes, but they also come with more volatility and are really influenced by local politics and economics.
Any examples there?
He uses the Germany fund right after the Berlin Wall fell. Huge excitement, prices shot up, then reality set in, and it corrected sharply. A classic example of hype getting ahead of fundamentals.
A good reminder about managing emotions. And he also mentions markets where normal analysis just didn't seem to work, like Japan back then.
Yeah, Japan in the late 80s, early 90s, the PE ratios, the price relative to earnings were just sky high. Didn't make sense based on traditional Western metrics. There were even theories it was like a cultural difference or maybe market mechanics we didn't fully grasp. It was tough territory for fundamental analysts.
Okay, so global investing has its own unique wrinkles. Now, the book is called Beating the Street. Let's get into the nitty-gritty, his stock-picking methodology.
Right. The second half of the book really digs into this. He doesn't just tell stories. He walks through his actual process. He even analyzes, in detail, 21 specific stocks he recommended to Barron's in early 92.
21 stocks across different industries.
Yep. Banks, cyclicals, companies sensitive to economic swings, retailers, utilities, a real mix.
And what's the big lesson from that analysis? Is there a secret formula?
Nope. That's actually the point. There are no pat formulas, as he calls them. No single magic number tells you if a stock's a buy.
So what is important then?
Understanding the industry. Knowing what actually drives profits or losses for different types of companies. What makes a retailer successful is totally different from what makes a bank or a car company thrive.
Industry specifics are key, not just general rules.
Exactly. And often, The best opportunities aren't in the glamorous sectors, but in finding well-run companies, maybe low-cost operators, even in boring industries.
Okay, that makes sense. And did he have a process for keeping track of his investments once he bought them?
Yeah, he talks about the 6-month checkup, basically regularly revisiting why you bought each stock.
Mm.
Has the story changed? Are the reasons you invested still valid? Any new red flags?
So it's not just buy and forget.
Definitely not. It's about staying engaged, staying informed, and being willing to admit if you were wrong or if things have changed.
Wow.
That kind of discipline is something any investor can apply, really.
A very disciplined approach. Now, he didn't just sit behind a desk looking at numbers, did he? He was big on real-world research.
Huge. He talks a lot about the value of visiting company headquarters, going to investment conferences, actually talking to management.
Getting that firsthand feel.
Yeah, you get insights you just can't get from an annual report. It's about understanding the people, the culture, the strategy directly.
Did he have any favorite questions to ask management?
He did. He apparently always asked, which of your competitors do you respect the most?
Ooh, that's clever. Why that question?
The thinking was, if a CEO admits a competitor is doing a really good job, that competitor is probably worth a serious look as a potential investment yourself, using their own intel, basically.
Smart. Okay, the book is packed with specific stock stories. Can we touch on a few key examples and the lessons they teach?
Sure. There's NBD and other regional banks. The lesson there was finding value in maybe overlooked, seemingly boring industries. These banks were growing steadily, but often had low valuations.
So looking beyond the hype.
Right. He also shares bits about his daily routine running Magellan, just the sheer intensity and constant information gathering involved. It wasn't a 9-to-5 job.
I can imagine. Any quick rules of thumb he mentions?
The rule of 72 is in there a simple mental math trick to estimate how long it takes money to double at a given interest rate. Handy for grasping compounding.
Useful shortcut.
And he observed that retailers and restaurants, maybe less sexy than tech, could offer really strong growth, potentially with less risk. Something to remember even today with all the tech focus.
That's a good point. Did managing such a huge fund like Magellan give him certain advantages or perspectives?
Definitely. He had the freedom, the latitude to make unconventional bets and to change his mind without facing constant criticism, which is a luxury many managers don't have.
Like what kind of bets?
Well, buying long-term treasury bonds in '82 when yields were sky high, or the big bet on Chrysler's turnaround in the early '80s, seeing the potential for the whole industry to rebound.
And as the fund got enormous, how did his strategy change? He couldn't just buy small companies anymore, right?
It became much harder. He ended up holding hundreds, sometimes over 1,000 stocks. Part of the strategy was taking small starter positions in many companies.
Sort of like placeholders.
Exactly. A way to tune in later, as he put it.
Yeah.
To keep tabs on them, learn more, and maybe increase the position if the story looked good. It required incredible organization. He even talks about planning vacations around time zones so he could still trade.
Wow. That's commitment. He also found value in investment seminars.
Yeah, efficient ways to meet lots of companies. But he'd also just go visit companies opportunistically outside of conferences if he was traveling nearby.
Like his trip to Sweden.
Right, where he did a deep dive on Volvo and thought it looked undervalued, even though it was a huge company. And he often mentions Fannie Mae. That was clearly a huge winner for Magellan over many years.
And when he stepped back to do part-time investing, did his approach change again?
It had to. Less time meant more focus. He talks about the rule of 5. For individual investors, maybe focus intensely on understanding just 5 companies at a time.
Manageable chunks.
And the importance of constantly reevaluating. He uses Cedar Fair, the amusement park company, as an example, a stock he liked, but revisited later when the valuation looked different. Your view has to evolve.
It's interesting, too, how he got ideas from just walking around a mall, like the Burlington Mall example.
Yeah. Seeing which stores were busy, what people were buying, the Gap, Body Shop, Nature Company. Real-world observation feeding investment ideas.
Simple but effective.
And he talks about Walmart's long growth runway, arguing against the fear that a stock is just too high if the underlying business still has room to grow and isn't saturating its market.
Assessing the potential left.
Exactly. And Pier 1 Imports comes up multiple times. He clearly followed that company closely, analyzing its ups and downs, its fundamentals, its growth plans over years. It shows the value of sticking with a story.
He even invested in supercuts, despite a bad haircut.
Yeah. That's a great little story about separating your personal experience as a customer from the investment case for the business model itself. Don't let one bad haircut blind you to a potentially good stock.
Good advice. Now, he talks about finding great companies in lousy industries. What makes them great?
Usually, they're the low-cost producer. They avoid debt like the plague. They treat their employees well, find a specific niche, and manage to grow fast, even when the overall industry is stagnant or struggling.
Any examples?
Crown Cork and Seal in the can business, Shaw Industries in carpets. He also admired the Sandler's conservative way of running Golden West Financial. It's about operational excellence, even in tough sectors.
And what about digging into troubled sectors, like the savings and loans back then? What did he look for?
For S&Ls, he focused on tangible things. Right. A strong equity-to-assets ratio, low levels of bad loans, non-performing assets, and solid management. He mentioned specific names like Glacier Bancorp and People's Savings Financial, and noted how mutual thrifts converting to public companies like Magna Bancorp did really well.
So, specific metrics to find diamonds in the rough. He also mentions things like REITs and MLPs.
Yeah, briefly. EQK Green Acres, a mall REIT that's a real estate investment trust attractive because of its high dividend yield and dominance in its local market. And Sun Distributors, a master limited partnership, which had a complex structure but potential value in selling off divisions.
Different structures, different opportunities. What about cyclicals, like automakers?
With companies like GM, his point was you often have to look at them when things look bad, when their PE ratio is low because earnings are down. That's when the potential rebound offers the biggest upside, assuming the industry recovers.
Contrarian thinking.
Very much so. He even looked at troubled utilities, often those with problematic nuclear plants.
That sounds risky. What was the play there?
The strategy he observed, and sometimes used, was to buy after they were forced to cut or eliminate their dividend. The idea was the bad news was out, the stock was beaten down, and you hold on hoping for a recovery and the dividend being restored. CMS Energy turning a nuke plant into a gas plant was an example. Also, the high yields on British water utilities after they were privatized looked attractive.
Interesting angles, and he revisits some favorites later on.
Yeah, he circles back to Fannie Mae, arguing why it could actually do well even in a recession, because lower interest rates would help its business, and people prioritize paying their mortgages. And Colonial Group, another one he felt was misunderstood and undervalued by the market.
He also admits missing some opportunities.
Like restaurant stocks in '92. He acknowledged their long-term potential even though he didn't jump in then. It shows humility and continuous learning.
And we see comparisons like Pure One versus Frank's Nursery.
Right, comparing how they used cash from certain transactions, how the housing market affected them differently, and comparing Callaway's Nursery favorably to Sunbelt Nursery. It's about digging into the specifics of execution. He even gives updates, like Sun Distributors selling assets faster than expected, or the ongoing saga of Tenera, stressing how crucial a debt-free balance sheet is for a struggling company.
Okay, so after wading through all those examples, industries, and stories, what are the big overarching principles he boils it down to? The key takeaways for investors.
There are some really solid, timeless ones. First and foremost, know what you own and know why you own it. No fuzzy reasons allowed.
Understand your thesis.
Exactly.
Yeah.
He also says long shots usually don't pay off. Don't bet the farm on Hail Marys. And don't try to own too many stocks. He suggests maybe 8 to 12 for a part-timer, focusing on maybe 5 really well at any given time.
Keep it manageable.
And it's okay to hold cash if you don't see anything attractive. Don't feel forced to be invested all the time.
That takes discipline, too. What else?
See market declines as normal. They happen. View them as opportunities to buy good companies cheaper.
Embrace the volatility.
Well, understand it's part of the deal. He says everyone has the brain power for investing, but not everyone has the stomach for the ups and downs. You need emotional resilience.
That's a huge point. Ignore the noise.
Pretty much. Ignore the constant worrying, the day-to-day headlines. Focus on the company's actual performance and long-term prospects.
And for mutual fund investors.
Don't switch funds constantly vary. Just chasing performance taxes will eat you up. Think about international diversification. And remember, over the long haul, well-chosen stocks have historically outperformed bonds or cash.
So you can really hear, listening to all this, how diving into Beating the Street gives this incredibly rich picture of investment thinking from that time. And so many of the lessons just feel, well, timeless.
They really do. From the simple insights of those 7th graders to the complex analysis of global companies, it builds a strong case that informed individuals can absolutely participate effectively in the market.
Yeah, the big takeaways seem to circle back to basics. Understand your investments, think long-term, don't get spooked by market noise or chase fads.
Exactly. The stories, the wins, the misses, they all underline that doing your homework and applying some common sense are really powerful tools. It's
Yeah.
not about secret formulas.
We really hope this deep dive sparked some thoughts for you, maybe some aha moments, and clarified some of these core ideas. The financial landscape keeps changing, of course, but these fundamentals, value, growth, patience, they seem pretty durable.
Definitely. So, thinking about everything we covered, what stands out most to you listening right now? What questions does this raise for you? Hopefully, it just fuels your own journey of learning more.